The cheat code: how rate base prints profit. Start with the formula they rarely spell out. A regulated utility's earnings are built on 3 layers: the cost of running the system, the cost of financing the system, and the allowed return on the assets used to provide service. Those assets, the wires, meters, substations, control rooms, sit in a ledger called the rate base. Regulators approve a profit on the rate base by applying a weighted cost of capital. Some debt, some equity. The equity slice gets a regulated return, often around 9 to 10.5% in recent years. Multiply that by the approved equity portion of the rate base, add in recovery of costs and depreciation, and you've got earnings. Now hear the incentive. If profit grows when the rate base grows, the safest way to keep earnings moving is to keep investing. A mile of new line earns. A substation rebuild earns. Advanced meters earn. Even the software that stitches those pieces together can earn if it's booked as a capital asset. Meanwhile, routine maintenance, tree trimming, line patrols, overtime crews, is operating expense. There's no profit on expense. So if you have to choose where to put managerial attention, capital wins. This is the CapEx bias. Economists warned about it decades ago. The nickname stuck: gold plating. Spend $1, earn on the dollar. Spend $2, earn on $2. Here's where decoupling enters. Under traditional rules, utilities recovered a lot of fixed costs through volumetric charges, cents per kilowatt hour. If people used less, revenue fell, even though fixed costs didn't. Decoupling breaks that link. It lets the utility true up revenue to an approved target, even if sales drop. In theory, that removes the disincentive to support efficiency. In practice, it means your bill can rise in a year you conserved because the company is authorized to collect its fixed costs and return regardless of your usage. The throughput incentive is gone. The earnings target remains. Add riders and you get speed. A rider is a surcharge approved to recover specific categories: storm hardening, infrastructure replacement, vegetation management, between full rate cases. Instead of waiting for the next case, the utility files a rider and starts charging sooner. Some riders include later prudence reviews. Many simply reconcile spending to collections. If projects are capitalized, they flow into rate base and keep earning. If they're expense, they clear through the rider as pass-through cost. Either way, cash moves faster from your bill to their ledger. Then layer in the allowed return itself. Commissions set return on equity using models and expert testimony. The stated goal is to match the company's market-based cost of capital. But in many jurisdictions, the awarded ROE has hovered at levels investors love: steady, bond-like yields with upside if the rate base grows. Infrastructure funds see a monopoly with inelastic demand, regulator-blessed returns, and a pipeline of projects pointed at a multi-decade transition. To them, the grid looks like a dividend machine wearing a hard hat. Now watch how modernization becomes a canvas. Advanced meters? Useful if they reduce theft, speed restoration, and enable smarter rates. But they're also thousands of dollars per meter in hardware, communications, IT integration, and vendor contracts. Every piece a candidate for capitalization. Distribution automation, voltage control, sectionalizers, reclusers, tools that can prevent outages. Or if overspecified, tools that bulk up the asset stack. Control centers? Necessary within reason. Or mission control, with redundant screens and software suites whose annual maintenance costs quietly swell. Notice what slips while capital shines. Fewer line workers on call. Longer vegetation cycles. Outsourced maintenance at fixed budgets. Dashboards don't clear a tree from a conductor. People do. Yet the spreadsheet rewards the substation rebuild, not the extra crew. When storms hit, we see the paradox. Spending up, outage minutes flat or worse. In the aftermath, a storm rider arrives. Recovery begins. The rate base grows again. Decoupling and riders have another side effect. They reshape fairness inside a class. As fixed charges rise to stabilize revenue, low-usage customers, renters in small apartments, seniors on fixed incomes, see less benefit from conserving. A bigger share of their bill becomes unavoidable. Add a handful of riders, and the energy line can be the smallest piece of a total. Use less, pay less? Sort of. Use less, pay a little less, but never escape the staircase. If you're thinking this sounds like the utilities are acting within rules rather than breaking them, you're right. This is the point. The cheat code isn't illegal. It's structural. You earn on steel, silicon, and software you own. You don't earn on labor you hire. If regulators award a generous return and allow frequent rider recovery, you'd be a poor manager not to pursue projects that qualify. And if investors are hungry for those predictable returns, boards will lean into capital programs sized to guidance. So how do you spot when necessary becomes excessive? Look for 3 tells. 1. Value for money. Does the capital project beat a cheaper operating alternative that achieves the same outcome? 2. Performance linkage. Are returns tied in any way to improvements customers feel? Fewer outages, faster restorations, lower arrears, or only to dollars spent? 3. Timing discipline. Are riders sunsetting or stacking? If the answer is stacking, your envelope tells the story. And there's the uncomfortable truth sitting under the $400 total. The grid needs investment. Climate is pounding weak points. New generation needs wires. None of that absolves the incentive math. Until profit leans more toward outcomes and less toward inputs, you'll keep funding assets that may not make your next storm shorter. Even as the line called system improvement fee keeps climbing, Wall Street's move in, infrastructure funds take the keys. While commissions fine-tuned returns and riders, something else was happening in boardrooms 3 time zones away. Infrastructure funds were circling like they'd found a toll road that never closed. The pitch decks were simple: monopoly service, inelastic demand, regulator-approved returns, and a multi-decade capital plan blessed by policy. Brookfield, KKR, Blackstone, Macquarie. The names you see on stadiums and skyscrapers started showing up on utility cap tables, bidding at premiums and telling investors they'd unlocked a bond-like cash flow with upside. Listen to how they describe it on earnings calls. Constructive regulation. Rate-based growth CAGR. Visibility. Those words mean the same thing. A regulator will authorize enough revenue to cover costs and a return, and the list of projects is long. A new substation, a rebuild here, a transmission corridor there. When the allowed return is steady and the pipeline is full, you can size a fund around it. Raise billions, acquire, lever to investment-grade tolerance, and drive capex that feeds the rate base. Guidance becomes a program. A recent bid put numbers to the thesis. An infrastructure arm offered billions for a regional utility at roughly 1.7 times rate base, a price that only makes sense if you believe 2 things: regulators won't choke growth, and customers will fund the expansion through rates. The premium wasn't for a breakthrough technology. It was for permission, the right to build and earn. Inside these deals sits a fee stack you never see on your bill. The fund charges management and performance fees to its investors. The portfolio company pays shared services to affiliates, IT, insurance, consulting. Sale-leasebacks can move assets to sister entities, sending rent upstream while the utility recovers lease costs and rates. Nothing here breaks a law, it exploits a scene. Regulated entities recover prudent costs. The corporate family decides how those costs are recorded. The first move after takeover is rarely dramatic. Executives promise continuity, capital discipline, reliability. Then the cadence shifts. Multi-year investment plans expand. Modernization grows a broader umbrella. Filings emphasize resilience, wildfire mitigation, cyber upgrades, the very categories riders can pick up mid-cycle. If commissions agree, spend accelerates and rate base follows. The guidance slide turns into a staircase. Meanwhile, dividends and distributions head upstream on a clock. Parent companies have their own investors to satisfy, so payout targets harden. If a rate case trims the ask or a storm year blows the budget, you don't usually see a dividend cut first. You see O&M savings, deferred maintenance, hiring slowdowns, contractor rotations. The spreadsheet protects capital recovery. Crews absorb the bend. Private capital didn't invent this incentive. It standardized it. Funds train teams to speak regulator and banker in the same sentence. They model decoupling impacts by class. They map where riders move fastest. They study which jurisdictions award higher ROE bands and which commissioners signal constructive. Then they deploy. A patchwork of state rules becomes a portfolio of cash flows that looks diversified on paper and unified in practice. Customers, not markets, are the backstop. Watch how the green story gets woven into this. The energy transition needs wires, big ones. High voltage lines running across regions, substations reconfigured for two-way flows, storage to firm peaks. All true. It also happens to be the highest margin theater for the rate-based game. Transmission earns for decades, with federal policies often smoothing allocation fights. Present that as climate necessity, and you've got both moral cover and financial momentum. Green plating isn't a slogan in a document, it's a budget category sized to earnings targets. You can catch the shift in small human moments. A control room supervisor gets a note, travel budgets tightened, training deferred to next fiscal. A line worker notices vegetation cycles stretched a month and a half. A city engineer hears that the undergrounding they asked for got scoped as a pilot, while a broader AMI upgrade moved forward at speed. Later, at the kitchen table, a new storm-hardening rider appears. The language is soothing. The math is not. From Wall Street's perspective, this is responsible stewardship. Mobilize capital, harden critical infrastructure, deliver reliable returns. From your vantage point, it's a transfer. Bill risk flows to households, execution risk shifts to crews, and financial certainty sits with funds that can exit when the next buyer arrives. The envelope pays for the premium and the plan. There's a reason these deals keep clearing. They align perfectly with the rules on the books. As long as returns are awarded on dollars invested, and riders keep receipts moving between cases, the grid reads like a safe asset with built-in growth. Until incentives change, the smartest money in the room will keep turning your necessity into their performance. And they'll do it with your signature, automatic each month, due on receipt. The Modernization Mirage, gold-plating the grid. Grid modernization sounds like a public good you can't argue with. AMI meters to spot outages faster. Self-healing circuits that isolate faults. New control rooms to see the system in real time. Undergrounding near hospitals. Who wouldn't want that? The catch isn't the aim. It's the way the label becomes an umbrella big enough to hide a lot of steel and a lot of margin. Start with advanced metering. The pitch is crisp. Instant reads, remote connect/disconnect, theft detection, time of use pricing. In practice, the meter is the cheapest part of the upgrade. The bill is integration, communications networks, head-end systems, data lakes, software licenses, cybersecurity layers, vendor support. Each slice is capitalized. Each dollar joins the rate base. When a pilot yields modest theft savings and slightly shorter truck rolls, the full rollout still lands because the platform needs scale. A year later, outages feel roughly the same to people on the end of the line. What changed reliably was earnings. Walk into the new control center. It's impressive. Tiered desks wall-to-wall. Displays, redundant feeds, a backup site across town. Necessary, up to a point. But plenty of rebuilds arrive with premium specs justified by black swan scenarios, then spend the next decade running Tuesday traffic. Meanwhile, in the field, the feeder that fails every August waits for a rebuild next year because the automation spend ate the slot on the schedule. Modern software won, old insulation lost. Undergrounding wears the whitest hat. It avoids wind damage and removes hazard trees from the equation. It also costs many times more per mile than overhead rebuilds. Used sparingly, it's a scalpel. Used broadly as hardening, it becomes a gold-plated ribbon across neighborhoods that didn't rank highest on risk. The selection tells you the truth. Where customers are influential, conversions move early. Where dollars are scarce, trimming cycles stretch. Then there's distribution automation. Reclusers, sectionalizers, voltage optimization, good tools. They're sold as no regrets because they reduce losses and reroute around faults. But overspecification piles on. Devices every few spans, software that requires vendor-only updates, analytics modules most operators don't use. You see invoices for features, not outcomes. On paper, SAIDI and sci-fi targets tick down a hair. On your street, the two longest outages of the year happen after storms snap the same untrimmed limbs. Cybersecurity is the one place no one argues to skimp. Still, watch the lock-in. A single vendor stack becomes standard. Future procurement ties to their roadmap, and switching costs balloon. Annual support contracts escalate with little scrutiny because they're bundled under critical protection. The finance result is tidy, recurring fees backed by capitalized platforms. The ops result is mixed, alerts aplenty, headcount unchanged. The modernization banner also hides an OPX diet. Every new asset creates a maintenance obligation, but the budget that feeds it doesn't grow at the same rate. Crews retire, contractors rotate, apprenticeships lag. A utility can point to record CapEx, while field supervisors juggle fewer people across more territory. Restoration depends on trucks, not dashboards, yet the spreadsheet's brightest cells live indoors. You can feel the shift in service calls. A homeowner reports a primary sagging close to a pine that's leaned all winter. The ticket gets a 20-day window. Storms bump it twice. 2 months later, the feeder trips and the same address sits 8 hours without power. The next bill carries a resilience rider. The note says investments are underway. They are, just not the one that would have prevented this. Modernization becomes performative when programs outrun measurement. If a utility can't show verified outage minutes avoided, energy saved, or customer minutes restored per dollar, the portfolio is branding. Value for money tests exist. They're too rarely required. When they are, projects look different. A sectionalizer goes in, a recluser waits. A conductor gets spacer cable, a decorative vault defers. In filings without that discipline, buzzwords do the heavy lifting. Self-healing reads better than retrimmed circuit. Storms expose the mirage. After a major event, we learn which investments were real. Hardened laterals hold. Risk-based vegetation work pays off. Undergrounding at choke points matters. But spend that chased rate base instead of risk? It fails noisily. Restoration depends on mutual aid and overtime, both OPX. Those invoices don't earn, they just clear. The month after, a storm recovery rider arrives and the cycle resets. There's a path that doesn't end here. It ties allowed returns to outcomes customers feel. It funds non-wires alternatives when they beat substation expansions. It forces riders to sunset unless targets are met. It requires hosting capacity maps and interconnection deadlines so distributed energy can defer capital. It channels federal grants first so ratepayers aren't financing what taxpayers already covered. It measures equity. Outage reductions where they've been worst, not where headlines are easiest. Until then, modernization will keep meaning two things at once. A handful of smart fixes that make the next storm shorter, and a portfolio that grows the rate base whether or not your lights come back any faster. The envelope won't tell you which one you purchased. The next outage will. The rider staircase, how bills rise between cases. Between full rate cases, the bill learns new tricks. They arrive as narrow filings with comforting names. Distribution system improvement charge, storm cost recovery rider, vegetation management adjustment. Each promises to recover prudently incurred costs for a specific purpose. Each is temporary. None feels temporary once it lands. Here's the rhythm. A utility files to launch or expand a rider with a defined scope. Regulators approve a cents per kilowatt hour adder or a monthly customer charge, often with an annual reconciliation. Work proceeds. The rider collects. When the period ends, remaining balance is true up. Meanwhile, a new rider arrives for a different bucket. You're not facing one surcharge. You're climbing a staircase of them. The genius is timing. In a traditional case, everything gets litigated together: revenues, expenses, investment, performance. Riders break the bundle. Storm costs can start flowing months after the event. Vegetation cycles can be front-loaded into the season. Infrastructure replacements can kick in at the beginning of a multi-year plan. Cash moves quickly, scrutiny fragments, and the total finds you before a headline ever does. Cash flow alignment is the phrase you'll see. It sounds reasonable. Don't make the company wait years to recover dollars it already spent to keep the system safe. But alignment cuts one way. When storms are light, few riders refund proactively. When vendor prices come in under estimate, the rider doesn't always ratchet down mid-cycle. The reconciliations happen later, quietly, while new riders arrive noisily. Now look at compounding. Imagine 3 riders at once: infrastructure, storm, vegetation. Each adds $1 or $2 a month, or a half cent per kilowatt hour. Stack them, and a modest home sees 10, then 18, then 30 extra dollars before any base rate change. Layer in a grid modernization rider approved last year, and a transmission adder set by regional tariffs, and the staircase steepens. You aren't paying one bill. You're paying 5 bills folded into one envelope. Fixed charges make the staircase feel steeper for low users. Riders tied to a flat monthly amount hit an apartment dweller harder than a large house because a bigger share of the total becomes unavoidable. Riders tied to kilowatt hours still stack on top of base energy rates, but decoupling true-ups can offset conservation gains. The signal gets muddy. Turn off lights, and a rider eats the savings. Small businesses feel it in margins. A bakery that proofed dough at night to dodge peak rates still pays the storm rider on every kilowatt hour and a flat infrastructure fee per meter. The owner raises the price of a loaf by a quarter and cuts a Wednesday shift. Upstairs, the landlord passes through the same riders to tenants on Plus Utilities leases. No one links the quarter at the register to a line a continent away, but the push is the same. Riders also reshape politics inside a class. Large users lobby to structure riders volumetrically. Low-usage advocates push for per-kilowatt-hour design to preserve a conservation signal. Utilities prefer fixed charges to stabilize revenue. Commissions split differences, then add balancing riders to smooth impacts. The staircase looks fair on paper and unfair on Tuesdays when the bill lands. Prudence reviews exist, but they arrive late. A storm docket 2 years after landfall confirms some costs were high, disallows a tranche of contractor overtime, and orders a credit. The credit appears as a small negative line on 3 bills while a new wildfire mitigation rider begins. You technically got your money back. The net still marches up. Then there's harmonization. In multi-division systems, riders can align territories. Town A's rates move toward Town B's averages as a regional vegetation rider spreads costs. Customers who had historically lower delivery rates lose the advantage without a single pole replaced on their street. The file calls it consistency. Your kitchen calls it a surprise. The escape hatch is supposed to be sunset clauses. A rider ends when the bucket empties, but buckets refill. Infrastructure plans become rolling programs. Pilot hardening becomes evergreen resilience. Storm seasons don't stop. Even when a rider zeroes, a successor appears with a new docket number and familiar language. You can track it if you're stubborn. Pull 12 months of bills. Highlight every line that isn't base distribution and energy. Note the codes R, RM, DSIC, SMP. Add them month over month. That rising sum is the staircase you're climbing between cases. Then scan the commission's calendar. You'll find the hearings that created those lines happened on Wednesday mornings with 6 people in the room. Riders aren't villainy by themselves. They fund real repairs fast. The harm is in accumulation without outcomes. If your outage minutes don't drop, if trees still scythe through the same feeder, if arrears rise and shutoffs resume, the staircase financed motion, not progress. That's the place to push. Require sunsets that actually sunset, tie continuation to verified results, and force bill impact tables that show the stack for a studio, a family of 4, and a corner store. Because once you see the steps, you can stop climbing blind. The green pretext, clean energy as CAPEX engine.